Welcome to the Explainer. Okay, let's just dive right into this breakdown of Entegris's latest earnings, and more importantly, why it's signaling a massive structural shift in their business. Now, if you follow the semiconductor space at all, you know exactly how wild the swings can be. But today, we're looking past all that noise to understand a company that is, quietly but aggressively, re-engineering its profitability from the ground up.
Before we get into the nitty-gritty numbers, we really need to remember what Entegris actually does. They are a true linchpin in semiconductor manufacturing. Think of them as the lifeblood of the process. They provide the absolute high-purity materials, the filtration, and the process solutions needed for the world's most advanced chips. As chips get smaller, faster, and way more complex for things like AI and electric vehicles, the purity of the materials used to make them becomes absolutely critical, and that is the exact space Entegris dominates.
So here is our roadmap for today. We'll start with the Q1 2026 earnings breakdown, look at the drivers of margin expansion, check out their free cash flow strength, explore those strategic market tailwinds, and wrap the whole thing up with valuation and the Q2 outlook.
All right, Section 1, Q1 2026 earnings breakdown. Let's start right at the top of the income statement to see exactly how the first quarter shaped up. $812 million. That's what Entegris delivered in total revenue for Q1. This was up 5% year over year and actually slightly beat the midpoint of their own guidance. Now, I know 5% might not sound like an explosive number, but put that in the context of the semiconductor capital equipment cycle, it actually shows some really resilient, steady top-line execution.
But here's where it gets interesting, and frankly, why we always have to look past those initial headlines. If you just glance at the GAAP operating margin, you're going to see roughly 17 to 18%. But when we adjust for things like the amortization of intangible assets from past acquisitions, it reveals a much stronger underlying non-GAAP adjusted operating margin sitting near 23%. That is a way better reflection of the core cash-generating power of the business right now.
So where is all that cash actually coming from? Well, it's split mainly into two big engines. The bulk of it is driven by their Advanced Purity Solutions segment at roughly $464 million, which is growing nicely at 7% year over year. In fact, that segment just marked its third consecutive record quarter for liquid filtration. Incredible, right? The other side is Materials Solutions at around $362 million, which saw double-digit growth in specialized chemistries.
Moving to Section 2, Drivers of Margin Expansion. This was literally the core narrative of the entire earnings call, and it's where the structural shift really takes center stage.
On the earnings call, CEO David Reeder made it crystal clear. He said, "We are focused on delivering our full gross margin potential, which we think is significantly higher than where we are today. The company is on a relentless absolute pursuit to maximize their manufacturing efficiency. Because it's not just about selling more stuff, it's about making substantially more profit on every single item they sell."
And that relentless drive, it paid off. They hit an incredibly impressive 46.9% gross margin for the quarter, beating their own guidance. And keep in mind, management noted that as volume continues to grow from here, they expect to squeeze out even more gross margin improvement through better fixed cost absorption.
Now, this 46.9% margin isn't some random fluke. It's a structural expansion driven by concrete physical actions. We're talking about driving manufacturing productivity, executing efficiency actions across their supply chain, improving yields, and getting a boost from a favorable product mix. A perfect, real-world example of this? They actually just closed a subscale manufacturing facility in Chandler, Arizona, specifically to streamline and optimize their entire plant network, trimming the fat, basically.
But, as careful analysts, we also have to talk about the accounting shift that contributed here. In early 2026, Entegris completed an assessment and extended the estimated useful life of certain property, plant, and equipment. For example, some manufacturing equipment went from, say, a 5 to 10-year life up to a 5 to 14-year life. By stretching that timeline out, they structurally reduced their depreciation expenses for 2026 by an estimated $72.9 million. And boom, that immediately boosts those reported margins.
Okay, Section 3, Free Cash Flow Strength. The real question is how these improved margins, both the operational ones and the accounting-driven ones, actually translate into cold, hard cash in the bank.
The answer? Very, very well. They generated a robust $144 million in free cash flow this quarter. That represents a massive 18% of their total sales. That kind of cash flow comes directly from those improved earnings and some seriously strict working capital discipline.
And they aren't just sitting on a pile of cash doing nothing.
They used it to immediately pay down $50 million in term loan debt this quarter. They are aggressively driving their leverage down. They ended the quarter at a 3.6 times net leverage ratio, and management confidently stated their target is to hit roughly 3.0 times by the end of 2026. Once that balance sheet is delevered, it opens up a whole new world of possibilities for shareholder returns in 2027.
Section 4. Strategic Market Tailwinds. Let's zoom out a bit and see how this financial discipline builds into their broader market positioning, because the macro environment here is absolutely vital.
Entegris is literally perfectly positioned across some of the hottest sectors in tech right now. If we look at their revenue makeup, about 40% comes from advanced logic, where utilization rates at advanced nodes are near effective capacity. Another 30% comes from memory, which is seeing surging DRAM demand thanks to those heavy AI workloads. And 25% is CapEx-driven, which is tied directly to new fab construction and equipment spending.
And we definitely can't ignore advanced packaging. If you've been following the AI boom, you know advanced packaging is a critical bottleneck right now in producing cutting-edge AI chips. Entegris already has an annual revenue run rate of over $100 million in this specific space, and they've got a very strong pipeline of new products to fuel future growth right there.
Finally, Section 5, Valuation and Q2 Outlook. Let's tie all these operational wins and market tailwinds directly to the stock itself to see what the immediate future holds. With the stock hovering around $127 recently, the financial research platform AlphaSpread notes the absolute importance of looking past daily market sentiment. We have to focus on the company's true intrinsic value. That's the value based on these expanding margins and robust cash flows we just walked through, completely ignoring the wild, emotional swings of the broader market. It's perfectly summed up by this Warren Buffett quote, highlighting AlphaSpread's core philosophy. Intrinsic value, driven by structural cash flow, is the ultimate truth teller for an investment. When a company is aggressively paying down its debt and expanding its gross margins exactly like Entegris is doing right now, that intrinsic value mathematically has to grow. Looking ahead to Q2, the momentum is clearly rolling forward. The company projects sales to grow between $815 million and $845 million. But more importantly, they expect to sustain that incredible gross margin, forecasting between 46.25% and 47.25%. They're also guiding for non-GAAP EPS of 76 to 84 cents. So these structural improvements, they are definitely sticking.
And you know, this operational discipline has historically really rewarded shareholders. Looking at the 5-year cumulative return straight from their 10K, it compares Entegris incredibly favorably against the broader NASDAQ and tracks right alongside the massive gains of the Philadelphia Semiconductor Index. When you corner a critical niche in advanced materials and manage your cash this well, the market absolutely notices over the long term.
Which leaves us with the ultimate question for your own research as we wrap up this explainer. With this relentless drive for efficiency, insane cash generation, and an undeniably strong position in the AI and memory supply chain, is the current stock price a bargain relative to its intrinsic value, or is all of this excellent execution already priced for perfection? That is what you need to decide. Thanks so much for joining me today, and keep exploring those financial filings.